All right, let's talk about one of the most popular high-stakes plays on the Nigerian stock market, especially right at the start of the year. We're talking about dividend capture. And we're going to zero in on the banking giants, the FUGAZ banks, as we look ahead to 2026. Just look at that number for a second. 15.97%. Seriously, that's the kind of dividend yield one of Nigeria's top banks offered recently. And that number, right there, is the whole reason this strategy gets investors so fired up. It's a huge potential return, and it really sets the stage for everything we're about to break down. So, let's paint the picture. It's January 2026. On the Nigerian exchange, there's a real sense of optimism in the air. This is that time of year when investors are basically glued to their screens, just waiting for companies to drop their full-year results and, more importantly, announce those juicy dividend payouts. And no other sector gets more attention than the banks. Now, this annual hunt for dividends really brings us to the main characters in our story today, a group of elite banks that go by a very catchy name. You're going to hear this term a lot, FUGAZ. So what is it? Well, it's just an acronym for Nigeria's 5 Tier 1 banking giants: First Bank, UBA, GTCO, Access Holdings, and Zenith Bank. These are the heavyweights, the big players. Everyone is watching for this dividend strategy. And here's why they're hogging the spotlight. I mean, just look at these numbers from 2024. UBA was leading the pack with that absolutely staggering 15.97% yield. But look, GTCO and Access Holdings weren't exactly slacking, both pulling in over 11%. Even Zenith, which is known for just being a steady, consistent payer, is right there in the mix. This is the kind of data that gets dividend hunters really, really excited. Okay, so with these incredible payouts just sitting there on the table, how do investors try to grab a slice of that pie without having to commit for the long haul? Let's get into the strategy itself. It's called the Dividend Capture Strategy, and at its heart, it is all about timing. This is not your classic buy and hold investing. Nope, this is a tactical in-and-out move. The plan is simple. Buy the stock just before the cutoff date to make sure you get the dividend, and then sell it right after. I think this analogy just nails it. You're not trying to take the train all the way to its final destination. You're just getting on for a very specific reason, to grab a valuable package, which is the dividend. And as soon as you have it, you're hopping right back off. Sounds easy, right? Well, not quite. See, to pull this off, you have to be precise. You have to live by the calendar. There are 4 critical dates that you absolutely have to get right. This is the playbook. So here are the 4 key dates. You've got the declaration date, that's the announcement, then the record date, when they finalize who gets paid, and the payment date, which, is when the cash actually shows up. But one of these dates is way more important than the others. The one that can make or break the whole thing is the ex-dividend date. And listen up, because this part is absolutely critical. If you want that dividend payment, you have to own the stock before the market opens on the ex-dividend date. Not on the day, but the day before. If you buy it on or after that date, you've missed out. The person who sold you the stock gets the dividend, not you. This one single date is the entire game. And hey, this isn't just some textbook theory. It's happening right now. A quick look at the Nigerian exchange's official calendar shows both Access Holdings and Zenith Bank have board meetings lined up for January 29th. That's basically the starting gun going off, and it's why traders are getting into position as we speak. Now, I know what you might be thinking. This sounds like a foolproof plan, right? A guaranteed cash payout, what's not to love? But here's the twist. The idea of free money in the stock market, it's almost always an illusion. And this strategy has a very, very big catch. And here it is, on that super important ex-dividend date, the share price almost always drops. And guess by how much? Yep, by an amount that's pretty close to the dividend being paid out. It actually makes perfect sense when you think about it. The company is literally about to send that cash out the door, so the value of the company itself drops by that same amount. The money isn't just created out of thin air, it's just moved from the company's pocket to yours. Let's make this super clear with an example. Say you buy a stock for 70 Naira, and it declares a 5 Naira dividend. Great. On the X date, you're officially on the list to get that 5 Naira. But the stock price is probably going to open at around 65 Naira. So you gained 5 Naira in cash, but you lost 5 Naira in the stock's value. What's your net gain? 0. A big, fat nothing. Let's go back to our train analogy. You got on the train, you grabbed your parcel, mission accomplished. But what if, at that exact moment, the conductor announced that the value of your train ticket just dropped by the same value as the parcel in your hands? That's the risk here. You could walk away with 0 profit, or even worse, a loss. And that's not all. This strategy means you're trading a lot, right? Well, all that buying and selling comes with costs. You've got transaction fees every single time, you've got the bid-ask spread to deal with, and then there's the big one, taxes. Holding a stock for just a few days often means you'll pay a higher tax rate on any gains, which can completely wipe out any small profit you manage to make. So, all this brings us to the big question. If the risk is so clear and the price drop is so predictable, why is this strategy still so incredibly popular year after year? Well, the only way you actually win at this game is if the market isn't perfectly efficient. You're betting that for some reason the stock price will drop by less than the dividend. Or you're hoping that the company's earnings report is so amazing that it creates a huge wave of positive feeling that makes the stock price bounce right back up. But let's be crystal clear. This is not a guaranteed paycheck. It is a calculated bet on how the market will behave in a very, very short period of time. And that really leaves us with this final thought. When you see those eye-popping double-digit yields from the FUGAZ banks, are you looking at a genuinely clever strategy for a quick profit? Or is it really just a speculator's gamble? Ultimately, the answer to that probably depends on your own appetite for risk and just how good you are at playing the timing game.